Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host Daniel, bringing you the highlights and the happenings from around the world. The third week of March offered a modest rebound across global equity markets, with a dovish-sounding Federal Reserve soothing nerves, while economic data painted a mixed picture. Central banks largely held steady, but divergences in inflation and growth trajectories are widening. Meanwhile, Europe maintains its surprising year-to-date lead. Japan keeps building momentum, and China's recovery remains uneven beneath the surface. Let's dig in. After weeks of declines, U.S. equities finally caught their breath. The Dow led the way, while the Nasdaq continued to struggle under the weight of underperforming tech stocks. Year-to-date, the tech-heavy Nasdaq is down nearly 8%, a sharp contrast to last year's AI-fueled surge. As expected, the Fed held rates steady at 4.25%, 4.5%, and reiterated its expectation of 2 rate cuts in 2025. But policymakers nudged inflation forecasts higher and trimmed growth expectations, citing rising uncertainty, particularly around trade. February retail sales rose just 0.2% versus expectations of 0.7%, while January's drop was revised even lower to minus 1.2%. But GDP-relevant control group sales were surprisingly strong at plus 1.0%. In contrast to the soft retail figures, housing data surprised to the upside. Existing home sales jumped 4.2%, and housing starts climbed 11.2% month-over-month. European equities were mostly flat to higher, buoyed by potential fiscal stimulus hopes, even as trade war worries loomed large. The big story: Europe is outperforming the US year-to-date, with a 14% gain versus the S&P 500's minus 3%. UK stocks inched higher, as the Bank of England left rates unchanged at 4.5% in a surprisingly hawkish 8-1 vote. Only one member pushed for a cut, defying expectations of a softer stance. The ECB, BOE, and Riksbank all kept rates unchanged, highlighting diverging inflation paths. The Swiss National Bank, in a surprise move, cut its rate to 0.25%, citing weak inflation and rising downside risks. ECB President Christine Lagarde said a proposed 25% US tariff on European goods could shave up to 0.5 percentage points off Eurozone GDP if Europe retaliates, adding a fresh layer of uncertainty. British policymakers remain worried about inflation expectations, especially with sticky services inflation. Japanese stocks bounced back as foreign investor demand and strong corporate earnings kept sentiment upbeat. The yen weakened toward 150 per dollar, helping exporters. The Bank of Japan held rates steady at 0.5% as expected, with Governor Ueda signaling a cautious stance amid trade risks. However, sticky inflation, core CPI at 3.0%, and healthy wage data keep the door open for eventual tightening. Despite upbeat economic data, Chinese stocks declined as investor skepticism lingers. The CSI 300 snapped its 2-week winning streak. Retail sales grew 4.0%, industrial production grew 5.9%, and fixed asset investment grew 4.1%, all beating expectations. But real estate remains a drag, with property investment falling 9.8% YoY and urban unemployment rising to 5.4%. Following these mixed signals, several brokerages upgraded 2025 GDP forecasts, betting that Beijing's policy push will deliver on its 5% growth target. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.